Welcome to the autopsy of the 2025 commercial vehicle industry. We are bypassing the ESG press releases to trace where the actual capital is bleeding. Today, we dissect the balance sheets of Daimler, Volvo, Yutong, and IVECO. What you'll see is a brutal reality. Traditional manufacturing is dead, and the OEMs surviving are those mutating into software monopolies on wheels. Let's cut the noise and look at the ledger. Net margins are vanity. Cash flow is sanity. Yutong is printing an industry-leading 13.4% paper margin, yet their operating cash flow crashed by 55% year-over-year. This glaring 0.58x ratio tells us their financial cash cow is mostly regurgitating uncollected paper IOUs. Meanwhile, IVECO sits on a 3.8x cash-to-profit ratio, a literal Scrooge McDuck vault of liquid resilience. Beware the profit illusion. If you are still just bending metal in 2026, you are a dinosaur waiting for the asteroid. The fundamental business moat has completely evaporated from hardware. The new apex predators are those trapping municipalities in an inescapable software and service subscription loop. We call it fleet as a service, and it's the most lucrative capital trap ever designed. Look at this zero-emission scale gap. Yutong moved over 18,000 units, enough pure EV volume to replace the entire active New York City MTA bus fleet 3 times over. The Western OEMs, they are essentially playing electric dress-up in the corner, keeping EV volumes in the low single digits, while aggressively milking their highly profitable legacy diesel cash cows to fund the transition. Europe and North America are walled gardens with stalling demand. To survive, Chinese OEMs are packing up and establishing localized assembly lines across the global south. It is a classic geopolitical game of risk. Yutong is securing African and Latin American continents via export aggression, while Volvo aggressively fortifies its European castle and divests from the East. Daimler is squeezing over $541,000 out of every single employee. Peak German engineering brutally applied to human capital. Then look at Yutong's 13.4% net margin. That is Silicon Valley software math surviving inside a heavy manufacturing ecosystem, which usually implies extreme supply chain leverage or accounting acrobatics that would make an auditor sweat. When operating cash flow drops below net income, red lights must flash. Traton and Volvo are burning through working capital like a crypto bro in Vegas just to fund their EV pivots. Their SUB 0.6x ratios mean the cash isn't hitting the bank. Only Bluebird is currently collecting cash fast enough to actually pay their electric bills. Total cost of ownership parity is the industry's favorite bedtime story. No OEM hits organic parity on pure battery electric without massive government handouts. Claiming EVs are cheaper right now is exactly like saying a luxury yacht is affordable because the federal government paid for the hull. Without carbon pricing, the math simply fractures. Governments are holding a regulatory gun to the industry's head. Miss the EU's 2030 CO2 cut and pay a €4,250 fine per gram over the limit. It's a forced march where you either incinerate billions on zero-emission R&D or bleed billions in fines, a classic heads they win, tails you lose scenario that permanently caps free cash flow. Unilateral R&D is now financial suicide. Because governments mandated EVs but forgot to actually build the power grid, mortal enemies like Daimler, Traton, and Volvo are holding hands to build charging networks. The Mylance JV is basically Batman and the Joker teaming up because they both forgot to pay Gotham's utility bill. The supply chain is splitting into 3 species. IVECO builds its own hardware to protect mechanical margins. Traton and Volvo write their own software to avoid being held hostage by Silicon Valley. Bluebird simply buys parts from external suppliers and glues them together, the ultimate high-stakes Lego builder relying entirely on Tier 1 mercy. Geopolitics just weaponized the supply chain. IVECO burned $226 million in free cash flow because delayed external components stranded entire fleets of unfinished buses in France. Meanwhile, Yutong's hyper-integrated domestic ecosystem meant they didn't miss a single shipment. Bulletproof logistics operating inside a global glasshouse economy. Mechanical horsepower is irrelevant. The new horsepower is the battery management system and the autonomous code. If you control the algorithmic pulse that decides when a battery degrades, you own the vehicle's soul. Outsourcing your BMS or AD stack is like handing the keys to your corporate safe to a stranger. Daimler and Volvo's Coretura joint venture is building the iOS of commercial trucks. Once a logistics company hardwires their routing software into this operating system, they are trapped. Trying to switch to a competitor's truck later would be like trying to run an iPhone app on a toaster. Pure ecosystem lock-in. Fleet as a service is the ultimate capital trap. Bluebird isn't just selling a bus. They lease the bus, the charger, the software, and the concrete it sits on. Try firing your OEM when your entire physical depot infrastructure is legally owned by them. You can't. It forcibly converts volatile CapEx into beautiful, recurring OpEx. The American school bus market is currently surviving on a federal subsidy addiction. Bluebird grabbed 21% of the EPA's first cash drop, but only 15% of round 3. When this $5 billion regulatory sugar high wears off, the withdrawal symptoms are going to decimate balance sheets across the sector. Volvo delivered barely 6,000 buses, but hit a record 9.1% margin by selling premium coaches to buyers who care about aesthetics. Yutong moved 58,000 units by surfing Chinese trade-in subsidies. You can win by selling 6,000 plates of caviar, or you can win by selling 58,000 hot dogs. Both are highly profitable. Volvo squeezed $12.6 billion out of software and services, enough to outright purchase the market cap of a mid-sized S&P 500 company in pure recurring revenue. Hardware sales fluctuate violently with recessions, but software subscriptions compound at a relentless 13% annually. It's the ultimate corporate leech, and it's structurally flawless. How do you build an impenetrable fortress? Network effects. If Volvo and Daimler own all the high-speed chargers, buying a competitor's truck means your driver is stuck in a field with a dead battery. It's a legal, functional monopoly built on copper wire and proprietary AI telemetry datasets. The survival playbook is set. Stop burning cash on solitary R&D. Standardize the metal through joint ventures. Monopolize the operating system and force your buyers into monthly ecosystem subscriptions. You aren't a vehicle manufacturer anymore. You are a tech platform that happens to have wheels. That wraps the public autopsy. We tracked the cash, ignored the PR, and mapped the actual moats. The industry bloodbath is just beginning. Hit subscribe to @HDIN230. Drop your contrarian takes in the comments. And if you need the unredacted data, reach out to sales@hdinresearch.com.